Welcome to Matters Financial and Geopolitical from a Frontier. Thank you as always for stopping by. Chinese President vows to correct the trade imbalance with Kenya. China is hosting a trade show in Shanghai for companies from more than 130 countries, including Kenyan traders and horticultural farmers, the presidency said in a statement. China is using the fair to showcase its willingness to open its market to other nations, according to the statement. China is Kenya's biggest trading partner, according to data compiled by Bloomberg. East African nations' exports to China amounted to $167 million, while imports were $3.78 billion. Kenyatta asked China to give African goods preferential access, similar to trade deals with Europe and the US, and to support the continent's producers to meet its sanitary and phytosanitary standards. Africa needs a reduction or an elimination of tariffs if exports into mainland China are to increase, Kenyatta said. The Markit Stanbic Bank Kenya Purchasing Managers Index rose to 54 from 52.7 the previous month. The onset of the short rain season, which so far seems quite positive for the agrarian sector, could help GDP recover in the fourth quarter of 2018, said Gibran Qureshi. I've been speaking about the rains being particularly benign. Kenyans cash in on the avocado craze. Look at the export curve. This is in the BBC. Earlier in the year, I wrote the millennials with their avocado eating and cryptocurrency trading ways are just as likely to be African as they are European or American. Equity Bank reported Q3 earnings and profit after tax was up 8.128%. They are holding investment securities of $1.58 billion equivalent. This is an issue now in the event of a government downgrade. 353 million transactions on Equitel this year compared to 13 million at the branches. And what has impressed me is that the subsidiaries recorded double-digit growth in profitability. Contribution to profit after tax is at 18%, that's only growing. Kenya shilling around the 101.70 level. I wrote a piece, the Kenya shilling is uppermost in most folks' minds. The shilling depreciated by 0.8% against the US dollar during the month of October to 101.8 from 101 at the end of September. The Kenya shilling, after last month's correction, remains positive versus the dollar for the year, one of the very few currencies in Africa and the world to have achieved such an outcome. We tend to be fixated on the dollar rate, but it's worth looking at a trade-weighted index, and what you will see is that the shilling has in fact appreciated against all its peers. There is a theory that we would be better served by a weaker currency, but I don't subscribe to that theory, essentially because there is no elasticity in our exports. A weak currency has not been a catalyst for a flood of exports. In fact, I would posit we're better off with a strong shilling because our import to export ratio is around 3 to 1, and therefore better off keeping a lid on prices via a strong currency. Ever since I can recall, folks have been arguing the shilling was overvalued, and I have found that many of these models simply do not account for the carry, the positive interest rate differential earned when you hold Kenyan assets component. The latest trigger for the spike in conversation around the shilling was the IMF, who said IMF urged the central bank to allow greater exchange rate flexibility given well-anchored inflation expectations and adequate reserves, saying this would boost the shilling's role as a potential shock absorber. The IMF reclassified the shilling from floating to other managed arrangement to reflect the currency's limited movement due to periodic central bank interventions. The currency, which is the fourth best performance globally, is also overvalued by about 17.5%, it said. The central bank reiterated its position on the shilling's value, saying the currency reflects its true and fundamental value. Our calculations support the view that there is no fundamental misalignment reflected in our exchange rate, it said. Today, if you scan sub-Saharan Africa, you will note many dual currency regimes, all of which are interfering with the free markets. Here in Kenya, you can exchange your money at a 50 cents bid-offer spread. Sure, the central bank and I rank their foreign exchange operations as an outlier when you compare it to any other central bank on the continent. Probably smooths lumpiness, but that is prudent and sensible. If you are aware of a lumpy trade, it certainly makes sense to spread it out because after all, participants have access to enormous amounts of leverage in the FX markets, and Kenya does not hold infinite FX reserves. I've always enjoyed passing the linguistics, and in this respect, the characterization of other managed arrangement is wrong on the facts as I see them. The finding that the shilling is 17.5% overvalued is also alarmist and not borne out by the facts. Such a devaluation would cry havoc with our debt-to-GDP ratios. The IMF raised its assessment of the chance of Kenya's external debt distress to moderate from low due to increasing refinancing risks and narrower safety margins in East Africa's biggest economy. Washington-based lender estimates Kenya's total debt will peak at 63.2% of GDP this year and gradually decline over the medium term. This compares with 58% in 2017 and 53.2% in 2016 when the nation ramped up infrastructure projects. There is an argument that we need to be tapping euro-denominated Eurobond borrowing and not just dollar-denominated debt. The central bank is sitting on the highest hard currency reserves in its history. Remittances have surged 71.9% year to year, last at 266.2 million in June 2018. Most important source of forex, bar none. Our single biggest expense item is of course crude oil, and you will have noticed that since the Istanbul incident, the Crown Prince has been finessing the price lower to release some of the pressure in what remains a pressure cooker. Of course, the markets would appreciate a more aggressive government of Kenya cost-cutting program. The key levels are from 2011 and are in the 105 to 107 range. In the matter of the shilling, I prefer to be long than short, and I beg to differ with the august and venerable IMF in this matter. Nairobi all shares down 14.59% this year. Safaricom is a conviction buy, as I wrote over the weekend. Great interview with Tim Carstens of Base Resources. That's a link to the bottom of the page. And the NSE 20 is minus 23.51% year to date.